The Indian footwear market has expanded rapidly, driven by rising incomes and changing lifestyles. India is now the world's second largest footwear producer and consumer after China, with industry value near $18 billion in 2024 and forecasts pointing to a 8 to 10% annual growth through the decade, reaching approximately $45 billion by 2032. India's macro backup remains broadly supportive as well. Even as GDP growth moderates, urbanization and rising per capita incomes fuel discretionary spending. As disposable incomes grow, footwear is viewed less as a mere commodity and more as a fashion statement and lifestyle choice. In a market marked by inflation, evolving consumer tastes and fierce competition, are India's footwear giants lacing up for double-digit growth or slipping into a slowdown? Let's find out. Welcome to Bottomline by Groww. I'm Radhika Bajaj. In today's episode, we'll take a deep dive into the Indian footwear industry, exploring the key trends, growth drivers, and challenges shaping its future. The Indian footwear industry has a very large informal sector active in it, with about 60 to 70% of footwear volumes happening in the unorganized segment. It is only in the past decade that the footwear industry has seen greater organization and is coming into the economic mainstream. To get a clearer picture, the Indian footwear market spans 5 distinct price tiers, each serving different customer needs. At the bottom end is the mass segment, where shoes cost less than 500 rupees. Here you'll find simple slippers and chappals made for everyday wear, which are unbranded and very basic offerings. This tier alone accounts for nearly half of every pair sold. Just above that lies the economy segment, with shoes priced between 500 to 1000 rupees. Now this is where entry-level sports and casual styles are, with brands like Sparks, Campus and Bata's Essentials line. Together, the mass and economy segment footwear makes up over 80% of all sales by volume. The middle ground is the mid-price segment, accounting for about 10% share by volume, covering shoes that sell for 1000 to 2000 rupees. Organized retail chains such as Bata's main lines and Metro brands Mochi and Metro outlets dominate here, alongside a growing wave of direct-to-consumer labels. Stepping up to the premium category that sells between 2000 and 3000 rupees, you enter lifestyle brands such as Hush Puppies, Crocs, Skechers, which makes up only about 3% of the market share. The mid-priced and premium segments are the fastest growing, fueled by rising incomes and increasing demand from aspirational buyers. At the very top sits the luxury tier, for shoes priced above 3000 rupees, and this remains a niche. But has this shift towards premiumization actually shown up in the performance of India's leading footwear companies? Among the 5 listed players, Campus Activewear, with a 20% 5-year sales CAGR, has outpaced its peers in top-line growth, followed by Metro brands at 14%. Both companies have translated this growth into superior profitability, reflected in Campus's 19% ROE and Metro's 21%. Despite Campus's stock price CAGR of -8% over 3 years, which lags Metro's 23%, its strong fundamentals and growth trajectory position it well for long-term potential in the footwear sector. But why has this been the case? In case of Campus Activewear, the brand has seized on booming sports and fitness trends with the smart tiered pricing play, as Campus achieved a solid 10% year-on-year revenue growth in FY25, reaching 1,593 crore rupees. This translated to a 35.5% growth in net profits. And this was thanks to operating leverage, as gross margins improved by 20 basis points at 52.3%. Expenses rose only 7.4%, driving a higher 20% EBITDA. And this happened because there was a focus on disciplined cost control and a stronger high-margin sales mix, such as through e-commerce. Campus experienced a slight 2% year-on-year decline in average selling price, primarily due to an increased mix of open footwear and accessories like socks, which carry lower average selling prices. However, this was offset by strong sales growth in premium products, particularly in its sneaker portfolio, which saw an impressive 150% growth in FY25. The success of this segment played a crucial role in maintaining strong margins despite the challenges in other categories.
In the case of Metro brands, it has a completely outsourced model and no manufacturing facilities. This keeps fixed costs low through variable lease rentals and sales-linked store compensation,
enabling industry-leading 30% EBITDA margins. The company achieved 6.4% year-on-year revenue growth by leveraging premium brands like Crocs, Fila, and Foot Locker, driving higher average selling prices and a more premium product mix. However, Metro's net profit declined 14.7% year-on-year, despite margin improvements. And this was due to a low tax base in FY25 via utilization of deferred tax assets. In line, Metro has one of the highest ASPs of 1,550 rupees compared to its peers. Moreover, Metro has shifted its focus away from the sub 1,000 rupee offerings and doubled down on premiumization. Products priced above 3,000 rupees now account for 54% of sales, up from 35% in FY20. Metro Brands has also expanded rapidly and strategically, adding 70 new stores in FY25, bringing its total to 908 outlets. The focus here has been on profitable openings rather than just increasing store count. Meanwhile, e-commerce performed exceptionally, growing 45% in Q4 and 20% year-on-year, driven by a strong channel mix, higher ASPs, and successful new customer acquisition. Both brands have successfully leveraged strong growth in the premium segment, driven by higher volume sales of fashion-forward athleisure and branded footwear with higher ASPs. Another mass segment player, Liberty Shoes, with just 1% sales CAGR over the past 5 years, has delivered a robust 16% profit CAGR. Additionally, its stock price has surged at an impressive 42% CAGR over the last 3 years. The reason? Stringent cost controls, especially on materials and inventory reductions, have boosted working capital efficiency, trimming the cash conversion cycle from 220 days in FY21 to 190 days in FY25. Despite the muted sales growth post-COVID, the company compensated by squeezing more profit via operational discipline, signaling an efficiency-driven growth. On the flip side, legacy players like Relaxo and Bata, which have primarily focused on the mass market, have experienced stagnation or even decline, with either flat or negative volume growth. Bata's growth has been sluggish. FY25 standalone revenue was 788 crore rupees, and this is essentially a minus 1.2% decline, mainly due to softened consumer demand. The gross margin declined by 229 basis points year-on-year, mainly due to the shift in channel mix, with the growth in franchise and e-commerce sales diluting margins compared to company-owned stores, which of course have higher margins. While Bata has introduced more premium products like Hush Puppies and Power Move, and has seen some success with brands like Floats, the overall shift towards premiumization has been slower than expected. In the case of Relaxo Footwear, which primarily sells flip-flops and chappals as an entry-level leader with an average selling price of 156 rupees, the company's FY25 revenue was 2,790 crore rupees. This reflects a year-on-year decline of 4.3%. The primary reason? Sales declined due to muted consumer demand, particularly in rural and middle income segments, where demand for lower priced products like Hawaii sandals was weaker. Another point to note is that Relaxo sales are predominantly focused on low priced, high volume segments, which has led to interesting pricing dynamics. For example, when Relaxo increased prices, the average selling price surged by 29%, from 124.6 rupees in FY19 to 161 rupees in FY23. However, this hike led to a drop in volumes. In response, Relaxo lowered the average selling price by 8% in FY24, resulting in a 14% year-on-year jump in volumes. This shift demonstrates Relaxo's limited pricing power, as increasing prices significantly impacts its core, price-sensitive customer base. While Relaxo has faced challenges with raising ASPs, it is now focusing on driving volume growth through value-oriented offerings at different price points. As such, the company has expanded its portfolio beyond budget footwear with the focus on premium lines like Flight. By maintaining affordability for budget-conscious consumers and introducing higher-end options, Relaxo aims to strike a balance between volume sales and premium products to drive growth going forward. However, both Relaxo and other players in the mass segment, including Liberty Shoes, are facing key common headwinds. First, in January 2022, the GST on footwear priced below 1,000 rupees was hiked from 5% to 12%, which disproportionately impacted the mass market segment. This segment, which constitutes around 80% of the footwear market by volume, faced significant challenges as the price increase squeezed affordability for a large portion of consumers. Second, the footwear industry has been hit hard by rising raw material and energy costs, with prices for key inputs increasing by as much as 50%. This has placed significant pressure on manufacturers who are struggling to maintain profitability while catering to price-sensitive consumer segments. Lastly, tighter budgets at the bottom of the pyramid are leading consumers to trade down or delay purchases, challenging mass segment footwear companies with weaker demand and pressured margins. Together, these concerns have subdued growth, causing these stocks to underperform. Aside from the listed players, India's footwear market features prominent unlisted and premium competitors as well. Puma and Skechers both target upper, middle, and youth segments with sports and fashion footwear. Reebok also covers the mid-premium athleisure segment. These brands have expanded fast, further intensifying competition. However, the potential for expansion and growth remains robust. Currently, India's per capita footwear consumption stands at just 1.66 pairs per year, significantly lower than the global average of 3 pairs and the 6 to 7 pairs per year typical in developed countries. This gap highlights a substantial opportunity for growth as incomes rise. With increasing GDP growth and rising per capita income, India's footwear consumption could gradually align with the levels seen in the more developed markets. Moreover, the government has set a target for the leather and footwear sector to reach $50 billion by 2030, aiming to develop globally competitive footwear. In the short term, demand is expected to improve from late 2025 as per capita incomes grow and inflation stabilizes, particularly during the festive and wedding seasons. Key drivers moving forward include further premiumization, with more consumers trading up, growth in urban consumption, and the clearing of old inventories of non-compliant imported shoes after the June 2025 deadline. The Indian footwear industry is undergoing a structural shift. Legacy mass market companies are struggling with flat volumes and must reinvent themselves through premiumization, digitization, and cost trimming. Meanwhile, players like Campus and Metro are thriving by capitalizing on style trends, network expansion, and digital channels. Rising incomes and urbanization are driving strong long-term demand, particularly for branded and athletic styles. How do you think legacy players will compete in this evolving landscape? Will they adapt successfully or struggle to keep up? Let us know what you think in the comments below.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.